We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Muir, author of the Macro Tourist newsletter and Substack, and co-host of the Market Huddle. Kevin, thanks for joining me today.
Tom, it's always a pleasure. I always love being on your show.
I always love talking to you because you bring a really rational way of explaining things to the markets, to financials, to all of these different areas that we focus in on. I particularly remember an explanation that you gave of MMT and, let's say, that type of strategy.
Right.
And I thought it was so excellent. That really stands out in my mind as one of the best explanations and conversations I've had around it.
Oh, well, I'm glad I can help.
It needs to be wider recognized just from an explanation standpoint. But we'll do our best to.
Right. And that's kind of always my motto, is that we can sit around and talk about what should be, but really we should be focusing on what will be. And at the time, a lot of people were embracing MMT. And so it was kind of, you could curse and spit on the ground all you want every time someone mentions it, or you can learn how, what it's going to do and go and position your portfolio accordingly.
Mm-hmm. Well, I think it's so important to, as you say, like, trade the market that you have, not the market that you want.
Exactly.
It doesn't matter how right you are, how skewed the fundamentals are. Right. That takes time to play out, but you have to trade the market that is, rather than the market that you envision that there should be.
Yeah, for sure.
So directly in that vein, Kevin, why don't we start by talking a little bit about the market dynamics since the election? It seems like there's days where some ideas are working and then the next day that gets completely reversed and then some. So do you think that the markets will be like this until either the inauguration or, maybe World War III officially breaks out?
Well, I think that it's the return of the Trump tape bombs. And I think people had forgotten what it was like trading from 2016 to 2020. Trump used to get up in the morning, he's on the toilet and he decides to tweet something out. And next thing he's moving markets. And this is what I always said to everyone. I said, now that once he won, I was like, get ready for volatility to come back, because that's the nature of Trump. And I think it's actually even more, I guess, exciting. And I wrote a piece the other day. It was called the Making Macro Great Again. And I really think that we are on the cusp of one of the greatest changes that we've seen in terms of how we think about markets, how we think about the economies, that we've seen in probably 20, 30 years. And what do I mean by that? If you go look at tariffs and their use throughout history, and I can't remember who it was. I think it was Barclays. I had this chart in one of my posts that I snagged from Barclays, and they had from 1800 to present day, and there was this chart of tariffs, and how much revenue as a percent of the economy that they've generated. And it's just this line that just goes down, 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 down. And then, it basically goes to zero. But we forget that before, in the 20s, and they had this Moot-Hawley thing, and in the 1800s, there was tons of tariffs. We've all grown up in an environment where we've basically had free trade. Mm-hmm. And now we're going to turn this around. And again, to the point of, it doesn't matter whether we think this is right or wrong. It's what's going to happen. Mm-hmm. And I think it's kind of interesting, because if I was to talk about the markets and what I view as one of the big opportunities right now, is that Trump has told you what he's going to do. Nobody believes him. Mm-hmm. And Wall Street is choosing to believe certain aspects of it that they want to be. They love deregulation. They love cutting taxes. They love cutting government spending. No doubt about it. I think he's going to do all those things. But I also think he's going to do tariffs. I also think he's going to devalue the US dollar lower. Mm-hmm. And I think that the kind of opportunities lie right now in thinking about this through and being honest about what he's about to do and then thinking about how it's going to fundamentally change the macro environment. And I contend that this is a huge, huge change. When I started talking about MMT, or when I talked about fiscal, I remember in 2020, March of 2020, everyone was very bearish on the economy, and everyone forgets this, but there was all sorts of people that were talking about how there was no way we could pay for all this fiscal stimulus, and that they were so bearish. Like, I went on a very famous podcast, and I remember it very clearly, and this fellow that ran it was very, very bearish, and he was one of these doom guys talking about how the world was going to end. And I got on there and I said, listen, if we do QE, and more importantly, if we do fiscal, meaning we spend it, the government can fill a lot of holes. And in terms of the economic hole that was going to be created by this slowdown. And the hate mail that I got was just out of this world. And it was shocking. And I feel like at that point, everyone's conveniently forgotten how bearish they were at that point, and how much they were convinced that this couldn't be the case. And yet, you had to be open your mind to MMT, the fact that if we did do this MMT where we basically spent it fiscally, we could actually fill a lot of economic holes. Now, we can argue all day long whether that worked in terms of maximizing our economic well-being.
And what the ramifications
right?
were
and a lot
on the
of people,
other end of that.
And not only that, I at the time said, we're going to get inflation. And everyone forgets now, but everyone thought we were going through a 1929 depression. Mm-hmm. And yet it was the very opposite. And so I contend now that there's an equally large kind of macro event that the market is failing to recognize. And it comes down to this. Donald Trump has told us he wants to get the trade deficits to zero. Now, whether he actually can, I'm willing to debate. Like a lot of people say, he wants to do that, but when he realizes the cost of it, he won't. And that is a valid argument. Mm-hmm. But I think one of the things that people don't realize is if he gets the trade deficits to zero, it will likely have a very negative effect on both the stock market prices and also interest rates in the US. And I think that's the part that everyone's missing. And if you think about the US, one of the kind of underlying fundamental tenets of the past couple, 20, 30, 40 years has been they run these large trade deficits. So they buy the world's crap or stuff, I shouldn't say crap, they buy the world's stuff and they export overpriced financial assets. Mm-hmm. The reason that the American stock market trades at such a premium is because they have this large trade deficit. And Trump wants to get that trade deficit down to zero. And if he does, I think it's going to have dramatic changes. Implications for the stock market prices.
Mm-hmm. So, Kevin, if we could, let's flesh that out a little bit more. Why does bringing the trade deficit down mean devaluing U.S. stocks?
Okay. Well, if you think about the trade deficit, why does it exist? And it exists because there's been a move towards free trade and this kind of globalism. Mm-hmm. And if you think about it over the past 20 years, like if you had a corporation that was all of a sudden, let's just imagine you were labor and you're working for a corporation and you started to go and ask for more money. You said, oh, you know what? Things are going up in price and stuff like that. I want to make some more money. And you'd go to your boss and ask for a raise. And the boss would say, listen, you're lucky to have a job. We're actually thinking about exporting all this to China or to India. And so there's been this globalization has unleashed upon the world this huge supply of labor. And with that supply of labor, it's meant that labor's percent of GDP has been just in a steady decline. And global profits, profits of these corporations has been in an uptick. So now that's globalization. That's what's occurred. And now all of a sudden Trump wants to reverse it. Mm-hmm. And if you stop and think about it, if you go and you're saying to yourself, okay, I used to make let's just take something like tractors. I used to go and the tractors would go and they would say, let's go build this in China because it's cheaper. Mm-hmm. And then all of a sudden they say, no, we actually have to bring it back to the US because we have these tariffs and stuff like that. Now all of a sudden your product's going to be more expensive because you're paying for more expensive labor. So this whole idea that these American companies that could make all this money, these tariffs are going to be pushing down on profitability. And that's, I think, the part that people miss. And as that kind of occurs, and as the trade deficit goes down, labor's share of GDP will be rising, but there will also be less money that is staying in the US. Because in the past, if you were, let's just say we bought something from China, we'd buy some, let's just take iPhones. We'd buy iPhones from China, and then Foxconn or whoever it is would get US dollars because we're paying for it in US dollars. And then they would just leave them in the US. Mm-hmm. And there was so much capital because of this trade deficit left in the US. Now, all of a sudden, if you're trying to get that trade deficit lower, it's going to mean the labor is going to make more, and then there's going to be less money recycling in the US financial markets. So all of a sudden, the premium that used to go on to US stocks will go down. And so I actually am kind of shocked that people aren't seeing this relationship. And yes, there are plenty of reasons to get excited about Trump's policies. Like, you can talk about deregulation. You can talk about them cutting taxes. Those are all bullish. There's no doubt about it. And in fact, I actually think that one of the greatest sectors right now to own is banks. Banks have been stifled. And ever since the great financial crisis, we've clamped down on credit creation. We've clamped down with tons of regulations. We've made it really tough for banks to make money. And now all of a sudden we got a situation where the Trump administration is about to say, just go at it, guys, go crazy. And I suspect it'll be terrific for banks, but it's not going to be terrific for the stock market as a whole. And I think that's the part that a lot of people miss, is that trade deficit, getting it to zero, is going to mean lower stock prices. That kind of U.S. exceptionalism premium that's put on the U.S. stocks is going to go down. Like, I can't remember the exact figure, but it's something like U.S. market cap of the world's stock market is 55%.
Right.
And the amount of profits they make is nowhere near 55% of the world's market cap. It's because they trade at a much higher premium. Mm-hmm. And a lot of that is this idea of the trade deficit. So now the next part of this debate, though, is as Trump goes to do these things, and as he starts to go and try to encourage companies to make more in the US, and those companies are all of a sudden faced with lower profits, and all of a sudden money is flowing out of the US instead of into the US, will he change his policies? Mm-hmm. And that is an argument I'm willing to kind of debate and agree on, that if that is the case, where he doesn't change the trade deficit and he just mouths words about it, then it's, then that's fine. The stock market won't go down. So it's really a question, though, of what he wants to do. Mm-hmm. And that is the part that I think everyone's missing. Everyone assumes that he is status quo. He's all for Wall Street, but I contend Wall Street didn't elect him. Actually, a lot of Wall Street doesn't even like him. Yeah, they are excited about his deregulation. They're excited about his tax cuts, but on the whole, that's not their pick. And I suspect that he's going to be more loyal to the average worker in Milwaukee and Ohio than he is to Wall Street.
Mm-hmm. Kevin, I recently heard an explanation of what's driving some of these insane valuations in stocks, like, for example, NVIDIA, let's say. And it's, mostly about these passive flows. No matter what, they just keep buying and buying and buying. So how does that factor into that analysis? And really, when we think about how that scale ends up kind of balancing out, is that still a larger force than the foreign capital that would leave?
Well, so like this, I don't buy this argument, this Michael Green argument, that the indexing is going to cause the very few stocks at the top to go to infinity and for everyone else to go to zero. Mm-hmm. And the reason I don't buy that argument is because ultimately what you're saying is the markets don't work. Because you're saying that no matter what price you pay for NVIDIA, you're going to continue to do that even when you can go buy a non-index stock that's trading at 1 PE, 2 PE, whatever it is. And so I've always contended that eventually, if that trend continues of where that the top of the indexing gets too expensive relative to the rest of the market, big long-term money is going to arb that. So if you're like CalPERS or your Ontario Teachers or Canada Pension Plan, if you're a big, somebody with a truly infinite time horizon, why would you sit there and buy the Mag 7 at 40 times PE when you can go buy other companies that are 2, 3, 4 times PE? And I understand that the Mag 7 is growing faster, so it's not quite an apples to apples thing, but it's still the one of the big reasons that an average active manager can't do it is because they will underperform the index and they can't take the career risk. But eventually, if this spread becomes too large, long-term money should arb that away. Mm-hmm. And so I just don't buy this argument that this is going to continue and that there's going to be those Mag 7s are going to go to infinity and everything else is going to go to zero, which is a lot of times what they argue. And I just think that it was kind of a combination of unfortunate events that caused this to occur. Like the AI came at just the right time. It also came at a time when there was all the stimulus, the fiscal stimulus in the actual market. It also came at a time when there was regulation clamping down on smaller companies that made it difficult for them to grow. There's a lot of things that kind of played perfectly for this environment of those Mag 7 and those stocks to actually keep going. And not only that, I think it's actually, Tom, it's even more, I don't know, insidious is maybe the right word to use than that, because there's actually more than the Mag 7. I have this subscriber that manages a hedge fund, and he likes to talk about the Nifty 20. And it's not like the Nifty 50, it's the Nifty 20. And he says there's like 20 stocks, and the one he likes to use is Costco. Like Costco is a great company, no doubt about it. Like shit, I go there all the time. Everyone loves Costco. Who doesn't love Costco? And there's no doubt that it's a terrific grower. It's nice and steady. But the thing about it is that it just scores so well on like a lot of these these screens, that what's occurring is that everyone just keeps paying higher and higher multiple for it. Mm-hmm. So if you go look at Costco, I can't remember it. I think it traded like between 10 and 20 PE for like 20 or 30 years, like a long time. And in the last 3 or 4 years, it's gone to 50. And this is not only that, this is at a period when interest rates are actually higher. Like it made more sense to be at a 50 PE when rates were 1% in the long end. This is with rates at 4%. Right. And so what we're seeing is the market being inefficient in a lot of these stocks. And what it comes down to is that there's so many of these pod shops. And for those who don't know what a pod shop is, it's a hedge fund that has what they call pods, which is a lot of individual managers. And a lot of these managers are very systematic, and they're just looking at quants and they're just looking at numbers. And if you kind of put a bunch of these pods together, you can make a nice stable, stream, this income stream that everyone wants. It's been one of the greatest things out there in terms of clients, what they've looked for. And these pod shops have raised just billions and billions of dollars, but it's just meant that there's more and more money being managed in this kind of fashion. And so it's not even like, everyone talks about the Mag 7 and the fact that this indexing is causing that. I actually think a bigger problem is that the reliance on these quant type things. I have a buddy that manages Canadian money, and he was telling me that within his shop, he's a big time money manager, and within his shop, he gets a list of things that he's allowed to buy. And that list is, in essence, based upon these same factors. So they all end up buying the same things and doing the same things. Mm-hmm. And this is just kind of life in markets. And Ed Sequoia, one of the greatest traders out there, he says, markets never change because they're always changing. and the market today is always going to be different than the market 5-10 years ago, in the future.
Mhm.
And I think you just have to realize that we do these different kind of weird things all the time that cause these kind of strange anomalies, and everyone's convinced that this is something that's going to occur and stay forever. But what'll eventually happen is everyone will wake up one day and go, hey, paying 50 PE for Costco makes no sense.
Mhm.
I can go buy, I don't know, some energy stock at, 4 times cash flow or whatever. And it'll be a change. And then all of a sudden the markets will trade better. The energy markets will trade better, and it'll gradually change. And then kind of 5 years from now, everyone will be like, why is everyone paying so much for energy stocks?
Right.
It's just the way it is. So,
so what you're saying is there's not necessarily a particular catalyst to change that behavior.
Yeah, not necessarily. Like, everyone talks about the .com bubble, and they have all their reasons why it burst. And the reality is it just kind of melted on its own weight.
Mhm.
Like, there is no real, everyone got up one day and realized that they laid too much fiber. Like, we could get a situation where everyone goes, and like, I personally think AI, like, let's just put aside whether it's going to change the world. Okay, let's just put it aside. I'm actually a seller. It's going to change the world. But even if it does change the world, it doesn't matter, because the reality is that they've gotten so far ahead of the pricing that that it's like, there's no way it's going to be very difficult to make money.
Mhm.
And this is kind of one of the things that I think is going to happen in AI is everyone was double, triple booking and ordering stuff because there was so little of it, and they all thought they had to overspend. And all of a sudden, we're going to just get this glut of AI, capabilities, and everyone's going to go, holy smokes, what were we thinking? And why are we paying so much for this company?
Mhm.
Like, at the end of the day, NVIDIA is still a semiconductor stock. Like, you're paying peak multiple for peak earnings right now. It's insane. And anyway, so I think that I think you can't sit there and I wish I could say it's going to be XYZ that's going to cause it.
Mhm.
And that, and it'll be the change. And there's lots of people who will be out there, they'll tell you those sorts of things. They'll have some grand theory and they'll give you this and that and stuff like that. And then the reality is it'll be just one day people wake up and it just kind of reprices and it just rolls over. And next thing you know, you're like, why am I long NVIDIA again? Like,
so the other leg of that stool, Kevin, was not only the tariffs, but the devaluation of the dollar, right?
okay. Yep.
So you mentioned also lower interest rates. So is that the mechanism by which you think Trump ends up using to devalue the dollar, or how does he go about that? And is there a particular order in which he has to do these things?
So this is one of the problems right now with Trump is that, first of all, well, it's always the problem with Trump. You never know what he's going to do.
Yeah.
But it's even more so now because we kind of know roughly where he wants to end up, but we don't know how he gets there.
Right.
And not only that, a lot of the things Trump says are contradictory. And it's not even like, I've seen him be contradictory, not even like in one speech versus the other. I've seen him be contradictory in the same speech. Heck, I've seen him be contradictory in the same sentence. So he'll say things like, the US dollar is going to have to be the reserve currency of the world. And everyone on Wall Street will jump on that and say, oh, look, he does not want to value the US dollar because he wants it to be the reserve currency of the world.
Mm-hmm.
Then he'll go and he'll start talking about how China and Japan are stealing growth because their currency is so low and that he's going to fix that. So this is one of those cases where I think that Wall Street is listening to what they want to hear, which is a strong dollar policy. But a strong dollar policy doesn't work with trying to revive U.S. manufacturing.
Mm-hmm.
Because no matter what you do, if you're trying to build something in the U.S., and the US dollar is overpriced on a purchasing power basis versus everything else, your costs are just too high. You just simply cannot compete, right? And that this is, at the end of the day, Japan and China have been stealing growth by having their currencies too low. He's not wrong. He's not wrong. Like, they have been doing that. It has been a policy and it's worked tremendously for them. And so everyone says, well, how is he going to do this? And I don't know how he's going to do it. Like, the reality is he could just go out and start bullying them and tell them they have to move it up. We could just, or he could go and say, we're not going to protect you, Japan, if you don't fix this. Mm-hmm. There's a million different ways that he can do it. You have to ask yourself, a lot of people will sit there and say, he can't do it. He can't really affect that. And I'm like, well, okay, let's first of all ask what he is wanting to do. And it seems pretty clear to me that he wants a lower US dollar. Mm-hmm. Yes, he wants it to be the reserve currency, but those two aren't mutually exclusive. Reserve currency just means that the world transacts in your currency. It doesn't mean that it's strong. And so I really think that if you go listen to the guy, you'll see that he is a weak currency guy. He really believes in two things: tariffs and a weak dollar. Like, that is ultimately his plan. So when you ask me, how do we get there? What order does he do things? I don't know. I just know the direction of the surprises are going to be on a weak dollar. And I think that Wall Street is sleepwalking into a currency war that is going to occur. Like, I really, truly believe, I think it was Louis Vincent Gav that talked about a Mar-a-Lago Accord, like a plaza type accord that where he gets everyone together and he says, no, we're going to revalue everything. That's the kind of thing that is more likely under Trump. And this is why, I keep saying, this is going to be the greatest environment for macro trading that we've seen in years or decades, because he is going to upset things.
Because of such a dramatic change.
Yes. And fundamentally, it has to do with a different way he looks at the world. Mm-hmm. That is the most important part. And so, again, I go back to this thing that Wall Street wants him to be a low tariff. Sorry, he wants them to be a low tax, low government spend, kind of get out of the way deregulation president. Okay. And he wants those things as well. Mm-hmm. There's no doubt about it. But Wall Street is missing the fact that he wants to be known as the tariff president. He believes in them. He's super excited about them. He thinks that they're going to fix everything. And then I think he wants to be a weak dollar president. Mm-hmm. He's not going to say that out loud, but I think if you go read what he says, go look at the Bloomberg Business Week article. He did an interview with them and he talked about it. He talked about the fact that the Japan and the yuan, the Chinese yuan have to be higher. Like that's just something that has to be. And so one of the things that I would encourage people to do is I recently wrote a piece and I included a link to this and I clipped a bunch of things. There's a fellow by the name of Robert Lighthizer, and he's kind of been one of Trump's, right hand, somebody who's had the ear of the president for a long, long time. Mm-hmm. And right now, everyone's excited about Scott Bessent. They're like, oh, he's going to do this 3-3-3 and everything's great. And, the reality is that Trump's not going to do tariffs. Scott was announced. And then within 24 hours, Trump was tweeting about a 25% tariff on Canada and Mexico. Mm-hmm. So just to think.
Kevin, sorry, explain who those two people are going to be in his cabinet.
So Scott Bessent is the Treasury Secretary. Mm-hmm. And so right now, Robert Lighthizer has no position. And This is the problem, is that people are kind of confused by this. What is Lighthizer? Is he really there? He's appointing all these other guys. So why should I pay attention to what Lighthizer says? Mm-hmm. And it's kind of like, do you think Steve Bannon or the new guy from Fox is going to have more of a say in terms of Trump's policies? I would say that Steve Bannon is going to have more of a say, even though he doesn't have official policy. And so one of the things I would encourage people to do is go listen to Robert Lighthizer, and he gave an interview for Lawfare, LAWFARE, and it's an hour-long interview, and it's enlightening. It's amazing to listen to his view of the world, and he is very much anti-free trade. He thinks the currency is being manipulated against them. And it's very much a lot of the things that you hear Trump saying. Mm-hmm. And this is who he's listening to. And you kind of have to ask yourself, is it going to be Scott Bessent that Trump has just kind of chosen over the last little while? Or is it going to be Robert Lighthizer that's been beside him for the past 15 years, telling him and giving him advice? Mm-hmm. And I'm betting that it's actually going to be more Lighthizer than it is Bessent. And the reason that Wall Street's so excited right now is because they think it's like one of their own is there with Scott Bessent. They think, oh, this guy used to be a hedge fund manager. He's gonna tamp down all of Trump's crazy theories. He's gonna stop tariffs. He's gonna get everything in order. I think he's there just to kind of smooth over, be a liaison between Wall Street and White House after Trump does whatever the heck he wants to do. Mm-hmm. And I think that is the great kind of question we should all be asking ourselves in terms of the markets right now. And that's where I think the great opportunity lies.
Mm-hmm. So, Kevin, that brings up the question to me of the idea of the Federal Reserve having some agency there as well, right? He doesn't, technically the president doesn't control the Federal Reserve. And, we know that there is, let's say, great opposition to him in there right now. So how does he get interest rates and the dollar lower if he doesn't have direct control of that? Well,
first of all, he doesn't have direct control of interest rates. You're absolutely correct. But in terms of like doing, for example, FX interventions, that's completely at the behest of Treasury. Okay. That is not a function of the Federal Reserve. And in fact, when you go and listen to the Federal Reserve, they go out of their way to say, we don't comment on the dollar, nor do we have any say in the dollar. So they generally will just completely avoid the subject. That is not their responsibility. Mm-hmm. In terms of interest rates, it is a great question because ultimately, I think that Trump is a low interest rate guy. Like he's a real estate guy. Like he's going to want low rates. And there is a little bit of a problem there in that it might be that the Federal Reserve doesn't go along with what he wants them to do. Mm-hmm. Now, he can try to just push them around. There's no doubt. And what people might not realize is that like in the 60s, Lyndon Johnson put up, I think it was McChesney or was it one of the other guys, one of the Fed chairs at the time, and pushed him up against the wall in a private meeting and like physically bullied him. So like it's not like this is a new thing that presidents have wanted to influence the Fed. And you might say that Powell is going to stick up to him, and maybe he will. And I suspect he probably will try to do it. But I think it'll be a source of battle. And I think that what a lot of Republicans might end up saying is that, President Trump was elected on this policy of, that he knows better. And you're not allowing the will of the people to be done. And ultimately, the Federal Reserve serves at the kind of, yes, they are independent, but they're still responsible to Congress. And Trump has a lot to say, in terms of influencing Congress. And I don't know how it's going to work out. I don't know if you're going to get a situation where he, tries to fire Powell, which Powell has said that he's unfireable. Mm-hmm. Could be, but like, what's going to happen to the U.S. dollar if Trump goes to fire him? Mm-hmm. So like you're worried about them getting the U.S. dollar down. I'm like, are you kidding me? That's like the easiest thing in the world to do. No, really, like I think it's funny because it's way harder to get your currency up. Mm-hmm. Like you're getting your currency higher is difficult because you need to convince people to invest in your country. To get your currency down, you just have to get people to leave. So if you go and he says, I'm going to fire Powell, and Powell goes, well, guess what? You can't fire me. And then they end up fighting in court. What do you think happens to the U.S. dollar during that period? I don't think it goes bid. Like I think it goes offered. And so to me, I think that the part that people miss is that Trump is willing to do a lot of unorthodox things mm-hmm. to accomplish what he wants to do. Like the way I look at it is that Trump 1.0 was kind of he almost won. It was a surprise. Like, let's face it, he wasn't expecting to win. Going into the election, Hillary was 87% chance of winning. And then he all of a sudden won. He's like, holy smokes, what am I doing? He didn't have a clue what he was doing. This time, he spent the last 4 years stewing, thinking about everything he's going to do, making a plan. And this is the part that I kind of end up debating with a lot of other hedge fund managers and other traders, is they tell me, he hasn't got a plan. He's just winging it. And I'm like, I don't think so. I think he's got a plan. And I think that these people that he's putting in place in their cabinet positions are specifically chosen so that he can dictate policy. He is not looking for advice. This guy is convinced he knows what to do. And listen, to some extent, like every time someone's given him advice and he's followed it, it hasn't worked. And the crazy stuff when he's actually done it, it's actually worked for him. So it's just encouraged his whole behavior of thinking he knows better. Mm-hmm. So anyways, back to the dollar. I don't think it's a big deal. And back to the Fed, I don't have an answer for you saying it's going to definitely be this way. Mm-hmm. All I know is that he is going to try to influence it, and that I would be very shocked if he just said, oh, well, you know what, hands off. The Fed is an independent body and we have to respect the wishes of the Fed. That to me is the part that would be the most shocking if he took a kind of Biden approach. Biden was like, okay, you know what, we don't like higher interest rates, but the Fed is an independent body. They're doing what's best for our country. Mm-hmm. That would be the shocking part to me if he did that. And the only thing I'm sure of, or not even sure, because a good trader never says sure. The only thing I'm confident of and expect is that doesn't happen.
Mm-hmm. Kevin, do you think that the market now sees less chance of a recession because of the Trump victory, and how is that being priced in?
100%. All you have to do is look at the forecasts. Bloomberg has one where they show the percent of economists who believe there's going to be a forecast in a recession in the next year. Mm-hmm. And if you look at that, you'll see that a year ago, everyone was expecting us to be in a recession. Now, I think it was the highest that it had ever been without an actual recession coming. It was 65%. It went down to 30 or something like that. And now since Trump, we've gone down to 25, even below that. And so when you ask how is that getting priced into the markets, it's getting priced in the market with people buying stocks, mm-hmm. People selling bonds, people bought US dollars. I think they were wrong for that, but they did buy US dollars because they thought, okay, the US is going to be a strong economy, so therefore I should expect the US to outperform, so therefore I should own US dollars. So it very much it got priced in. The only thing I will say is that it's increasingly, the amount of optimism out there has almost made it so like, even if he ends up doing all the things that people expect him to do, it's going to be already in the market. Mm-hmm. And it's going to be a tough bar to kind of jump over, a tough hurdle to meet.
Mm-hmm. Kevin, as we're talking about these different currencies, you have two currencies that you're really watching, right? There's one that you hate and one that you love. So which one would you like to start with?
We'll start with the one I love. The one I love is the yen. I think the yen is one of the, like, it's so cheap on a purchasing power basis, meaning like if you go and you look at, like, when you go to Japan, just go to Japan and buy yourself something. And I tell this story that I love to tell. I took my family there. This was a while ago, like a year or two ago, when the yen was like 140 or instead of 155 or 160 or wherever we are now. And I went there, and I have three kids, and one of the kids is the youngest is a boy, and he was like 17 or something at the time. And we get off in Tokyo and we're like looking for somewhere to eat. We go into this kind of somewhat fancy restaurant and we sit down and we get taken into this room, in like our own little room. We're sitting there. It's really nice, very Japan-like. And my son sees Wagyu beef and he starts ordering these fancy things. And I'm like, oh God, this is going to cost me a fortune. And I'm like, oh, sit there. And then all of a sudden the bill comes, and the bill at the end of the night. And I look at it and I go, oh God, it's $2,100. I really screwed up. I shouldn't have let him do the Wagyu beef. And then I realized there's so many zeros in the stupid currency. I got the digits wrong. It was $210 for five of us eating, and he's eating like a king. And my point is, it's super cheap to go there. Like, it's just shockingly cheap. Then you go to Miami or wherever in the States, and you're like, holy smokes, this is the most expensive place I've been around.
Like $200 for McDonald's.
Yeah. Like my hedge fund pals, they go to all over Europe, and all they can tell me is, my American hedge fund pals, all they can tell me is like, everything is so cheap. Mm-hmm. And the American dollar is so expensive, and the cheapest of the cheap is the Japanese yen. So there's a million other reasons I like it. I think that there's reforms coming. I think the stock market is going to do one of the best performing out there. All sorts of reasons to love it. And not only that, I suspect that the Japanese will more likely fall in line when Trump comes and asks them to revalue. So China, I'm not so sure. I'm not sure what's going to happen with their currency. China goes and, Trump says you need to revalue. China might say no, pound sand. And I'm not sure how that's going to go, but I suspect Japan is going to be like, yes, sir. And it's going to go from 155 to 120, which means a stronger yen or something like that. So that is by far and away my favorite currency. The currency I hate is my home country, and yours too, I believe, right?
Mm-hmm.
Yeah, Canada. And the reason I hate Canada is, I shouldn't say hate Canada. The one
dollar.
Yes, the dollar, because I love Canada and I'm a big Canadian fan, and I don't want you to think I'm just kind of crapping all over my country because I see all the faults. The reality is I'm bearish Canada because I think that all the reasons that people were worried about the U.S. economy, last year when there was that huge conviction, that high conviction out there that the U.S. was about to go into recession, all the reasons that they were worried about the U.S. were double in Canada. And so what do I mean by that? I'm like, okay, so if we go look at the debt to the GDP, like you go look at the US, everyone's worried about the amount of debt that they have. Well, the government has a lot of debt, but really what you worry about in terms of the debt is the amount of the people have. And so the debt to GDP ratio of the consumer in the US and Canada went up basically at the same rate in all the way to the great financial crisis, got to 80%. We were slightly behind the Americans, so we were 75. And then what happened was, or 100%, then it went back down to 75% in the US, meaning that they had a deleveraging. Their US, the consumer took less debt. Mm-hmm. In Canada, we just kept adding it and adding it and adding it. And it's absolutely crazy. We are one of the highest consumer debt to GDP rate countries in the world, if not the highest. And then you combine that with the fact that we are real estate, which is basically where that money has gone into, is super, super expensive. It's gone through the roof. And everyone used to say, like, I've been wrongly bearish on Canadian real estate for early. I was early. And I remember I had a buddy that was he was a big real estate guy. Like he ran one of these big, huge funds. And he told me, he always used to say, I'd be bearish. And he'd say, Kevin, we're a world-class city. Like, we're still cheap compared to Paris and London and New York. And when you start going that was the case like 10 years ago, 20 years ago. And now I saw something the other day and it did the average home in Toronto versus the average home in London. It's not that much different. Like when you convert it into the same dollars and stuff like that. And we are all of a sudden fully priced in. And listen, I love Toronto. I love Canada, but we're not in the same league as New York and London and like Milan. We're not the same. And our real estate is equally priced, and it's just gotten stupidly, nobody can afford it. And so now all of a sudden we got this rolling over, and here's the real kicker. Coming out of the coming out of COVID, Canada went and we all stimulated fiscally. The whole world did. And one of the reasons American economy did so well was they were the biggest spender. They spent 24% of their GDP in terms of stimulus. And so when everyone's always surprised about how well the US did, I'm like, no, they went crazy. This was like levels that we haven't seen since World War II. Like this was absolutely insane. So that's part of the reason they did well. In Canada, we were a little more reserved. We're Canadian. We did it a little less. I think we did 16%. But our economy also did well. And you say, well, why was our economy doing well? And the reason was, although we weren't spending, we were expanding our immigration at a level we haven't seen since the baby boom, right? It was absolutely insane how many people we started taking in. And when we did that, it made GDP look like it was growing. But what was happening was the GDP per capita was actually shrinking. So if you look at Canada, I think from like 2020 to 2023, we had the second best GDP growth out of the G7. Okay. But when you do it on a GDP per capita, ours was the worst.
Mm-hmm.
And so what that means is that we really didn't, like, the Americans might have done it all fiscally, but we did it all through this immigration. And then what happened is that this immigration, all of a sudden there was tons of strains because we let too many people in and we couldn't handle it in terms of housing them. Everything started going up in terms of the prices for this education. And we didn't do ourselves a favor. We didn't do the immigrants that came to our country a favor. It was a complete and utter disaster. It was one of the worst thought out policies in forever. Mm-hmm. And so what's happened now is that we finally kind of realized this, that, hey, wait, this was not very well thought out. And so we've gone from letting in like 1 million people a year to zero. Okay, so we all of a sudden just gone, and this source of growth is gone. And then we combine this with the fact that we had one of the dumbest central bankers out there. And I'm not one to crap all over central bankers because I find it's a tough job. And it's difficult, and everyone always has an opinion after the fact and stuff like that. But there are some moves out there that are pretty clearly wrong. Mm-hmm. Tiff Macklem is one of the dumbest ones out there because he was trying to be cool and to get out ahead of the U.S. in terms of stamping down on inflation. So we were actually, for the first half of the hiking cycle, we were more aggressive than America. Now, when we go look at us versus America, we have significantly more debt. And more importantly, our debt is all mostly floating versus America. They have 30-year mortgages. So we have all this floating debt, and they're like, it's resetting. It's somewhere between like 3 and 5 years it rolls over and stuff like that. So these people, all their mortgages. So he's cranking rates like there's no tomorrow. Okay, because he's like trying to be cool. He's trying to be, better than more aggressive than the Americans. So we have more debt. It's more. We're resetting ours more quickly, and yet we have all this immigration. So he took our rates to levels that is going to absolutely crush our real estate market, and it's finally occurred. He's finally managed to break the Canadian real estate market, and it's gone no bid. It's going to continue to go no bid. And the only way out of this for us is for us to allow our currency to go down, for us to keep rates low and basically inflate our way through this problem. And there's a big precedent for this. This happened in the 80s. Same thing. We had a huge boom. And then what they did was, and then we got into some trouble. Real estate went down. And if you look at it, I think it was like 89, real estate started going down. And when you look at it on a real basis, it actually went flat because the dollar was going down so quickly. Right. So they found a way to change the debt, like change it so that everything else was buoyed up by a lower Canadian dollar. Mm-hmm. And that is in essence what's going to happen here. And that is the way out of it. And so when I think about trades for Canada, I've been bearish and short the loonie forever. I continue to be. It's one of my favorite trades. But, and I will say this, if you think about our economy, Canada is a very resource-oriented economy. And we have a lot of really high-class, resources that are like long life resources. Let's just take like CNQ with their oil sands, mm-hmm. or Agnico Eagle. Like these are long reserve life assets. Okay. We're going to start, all of their costs are going to be in Canadian dollars. And the thing they're selling it for, it's going to be American dollars. It's going to be worth way more. Mm-hmm. So I think that this part of the Canadian economy is going to boom. It's going to print money. I'm assuming Trudeau loses the next election. We get a Trump light, basically with Pierre Poilievre. Mm-hmm. And although everyone's going to think that you should buy the Canadian dollar, I still don't think you should buy the Canadian dollar. I think it has to be the reserve, the outlet for this problem with our real estate. Mm-hmm. But I think the one thing you can do is buy our resource stocks and be careful. You don't want to just buy because it's listed on Toronto. You don't want to just go, right. I'm owning that Toronto stock. If you think about First Quantum, they have some big copper deposit in where is it? Like Panama. So First Quantum is this big Panama copper deposit. Well, the Canadian dollar, it's irrelevant. It doesn't help you. Like, that's not a Canadian dollar asset. You want the Canadian resource companies that have Canadian assets. Mm-hmm. And I think they're going to be some of the best performing stocks in the next cycle.
That's, I mean, sound reasoning, Kevin, and I can't disagree with it. And, you know, just imagine, I was having this conversation the other day with a friend of mine. Just imagine, let's say Pierre Poilievre coming in to this absolute disaster and, you know, the problems that he faces and, you know, trying to figure out what your next steps are to actually move forward as a country. Yeah, no, it's tough. Now, the only thing I will say is that, you know, going back to our MMT discussion, mm-hmm. one of the things that I think is still out there in terms of people's expectation is they somehow think that balancing the budget is going to mean a strong economy. And I think that they've forgotten that, like, they were the ones who told us that, you know, you couldn't make economic activity, you know, when we had March 2020, you know, during COVID. Mm-hmm. And one of the things that I find kind of frustrating is that people don't realize is that the government's deficit is the private sector's credit, right? And I know, like, if you just think about it logically, like, when the government spends money, it has to go somewhere. And that money is actually the private sector's credit. Like, that is the private sector's on the other side of that. So if you go actually look at the deficit versus profits of America, like, if you go chart those two, mm-hmm. they're perfectly inverted almost. Like, it's shockingly, you know, amazingly clear. And so one of the things I worry about if I'm thinking about, like, Canada is that you're going to get a Pierre Poilievre in here. He's going to go, we got to balance the books. Mm-hmm. And then everyone's going to rush in and buy the Canadian dollar because they're going to be like, oh, he's going to be great. He's going to do great things for us. And that is actually going to mean that there's not enough credit creation in the economy when he tries to balance the books. Mm-hmm. And what'll happen is that'll just end up slowing the economy all the more quickly. And so it's a difficult thing. And, like, even Trump, one of the things that I'm grappling with in terms of when I think about all the pushing and pulling that is occurring with the different types of policies that he's doing, on the one hand, he is doing deregulation, and especially for the banks, that is hugely beneficial. And because that is going to encourage private sector money creation, meaning, like, people are going to go out and they're going to be like, hey, you know what? The bank will all of a sudden lend me a house, you know, money for my house. And, you know, here's a little side note. When Bernanke was chair at the Fed, he went to go, and this is in like 2016, he went to renew his mortgage and he got denied. And the reason he got denied was because they were busy going and, like, trying to clamp down on credit and trying to, like, limit the amount of private sector credit creation that could occur. Mm-hmm. And so now Trump is going to just allow this to go through, you know, and go crazy. And so the trouble is, you don't really know how much that is because it's based upon demand, right? Like, we're not sure. It could be huge, like everyone could go out and borrow, or it could be that there's none. So we don't know. And so one of the things I worry about is that you get this Elon and Vivek, they're talking about just destroying the amount of government spending, right? Like, they're going to just cut back on this. So that in itself, like, if there was only one piece of policy that occurred, let's just imagine Trump did one thing and he just stopped the government spending. He came out and he just cut it in like half. Mm-hmm. That would be terrible for the economy. That would be like the books would balance, but the reality is there wouldn't be enough money creation, that it would actually tip us back into a recession. It would be negative. Mm-hmm. Like, this is what happened in the 1920s or the 30s. Sorry. When they started to do it, they were like, no, we have to balance the books. So they would go and they were convinced that their problem was too much debt. And so therefore, the moment that the economy started going, they started raising taxes and doing things like that. Even Japan had this problem. Every time the economy got going in their land of, of zero interest rates, it would start to pick up steam, and they go, oh, well, now we're worried about the debt. We better raise taxes. They go raise sales taxes.
You know, and like, and if you think about a lot of the things that Trump's doing, even tariffs, that them in themselves are deflationary. You're just causing people to have less money in their jeans. The price of everything's going to go up, so they're going to have less money to spend. So you know, a lot of these things that Trump is doing is deflationary, but at the same time, he's going to go and he's going to cut taxes. So that's inflationary. That's fiscal stimulus. You know, and then this thing with deregulation, back to the banks, we don't know the private sector credit creation. Does he unleash a huge amount? And it actually could be inflationary. And so this is why it's so difficult right now, is that you can weave a story either way. Like if you said to me, weave a bearish story for the economy and tell me why I should buy bonds, I could tell you. I could say, well, Vivek and Elon are going to come. They're going to cut too much. The reality is that there isn't as much demand for housing as we think there is, and all of a sudden they're going to cut taxes. But if we think about who actually gets what in terms of taxes, who spends the most, is it the propensity to spend is very low on the people you're going to cut taxes for. So the reality is that all of these things are deflationary. The economy just rolls over. So I could make that argument, but I could also make the argument that no, they're going to come, they're going to cut taxes, they're going to cut the government regulations. Everyone's going to be excited about it, and they're going to go out and borrow tons of money. And all of a sudden, we're going to get this private sector credit creation boom. And so this is the problem, is that we're at this kind of very difficult stage in terms of this handoff. In the past, it was easy because there was no private sector credit creation. Like in the last kind of post GFC, the private sector has basically been useless because they've been so hamstrung by all the regulation. Now all of a sudden we're going to try to get them going again, and the trouble is we're not really sure how well it's going to work.
Right. Yeah, that's, again, I've been using this analogy way too much, but the scale and how it ends up balancing out is so important, and always trying to analyze all these different forces is such a difficult thing because some can be far more important than others. Some of these.
Right. And we don't really, and if anyone tells you they know, then you should ignore them. Because the reality is we don't know. Because first of all, we don't even know the mix that Trump's going to do. Right. So we don't know how much deregulation, we don't know when it comes and all this things. And then we don't know how the public's going to react to it. That's why macro is going to be so awesome. There's literally going to be huge potentially change, like things that we haven't seen in many years occurring. So stay open-minded. That would be the real advice I'd give people. Stay open-minded to the possibility that really anything can happen.
And be able to admit when you're wrong and be nimble,
for sure.
Right?
Yeah, for sure. Now, at the same time, the markets can do some funny things. So be careful about assuming that you're wrong because prices have gone against you. Because it could be that that's actually just the market misinterpreting things. And so make sure you trade it in a scale and a timeline that can allow you for the time it might take the market to figure some of these things out.
Right.
Like I personally believe that Trump is going to be much more negative for the stock market than people think. And so I told somebody before the election when it was still up in the air who was going to win. I said, here's my playbook. If Trump wins, I'm going to wait for them to rally them all, because they'll rally them all, and then you give it to them. And so I need to kind of like, that was my plan. So I am increasingly more negative, like as it's gone through, but it wasn't like I was like, oh, Trump won. I think that this is going to mean lower stock prices, so I'm going to start selling it. The reality is I understood that people are going to be very bullish about this and are very excited about it. So I was in no rush to kind of lean into it right away. I wasn't like, I'm thinking to myself, okay, in the meantime, everyone's going to believe this. So therefore there's no sense in me rushing with my sell tickets.
Again, order of operations.
Yeah. And it's like, and you kind of, but I do have a very much a different view than the market in terms of my expectation is ultimately he's going to be more true to the workers that elected him than to Wall Street. And ultimately, that is kind of my assumption. And listen, I'm open to the idea that I'm wrong. And like you said, be careful, like be open to the idea you're wrong. If I saw him doing things that were very clear to me, he was going to throw the worker under the bus, I'd be like, okay, I was wrong. I shouldn't have trusted him to do what he said he was going to do. And he's actually going to be the same as all the other ones. But I really think he wants to go and help the little guy, like the average, worker. And I really recommend people go listen to that Lighthizer hour-long interview on Lawfare, and go take the time, because when you listen to that, you'll realize it's a different mentality than we've been dealing with for the past 10, 20, 30 years. And I think that's the part that the market is missing.
Kevin, when we think about again, the scale analogy, what do you think is the most, let's say, the most important 500-pound gorilla when it comes to the scales of gold?
Okay, gold. So I think it's funny that folks are still stuck on this idea that there's that geopolitics mean everything, and that the US dollar means everything, and that the interest rate spreads mean everything. And I really contend that you're trading against one player out there, and that is the People's Bank of China. And you're in essence playing poker against them. And why do I say the People's Bank of China? There's other central banks buying it. Yes, there are, but the reality is that the People's Bank of China, the amount of reserves that they have in US dollars is astronomical. And when US went and seized assets of the Russia in 2022 when they invaded Ukraine, they forever changed the calculus that other countries such as China have to use when they're thinking about their reserves. They can no longer assume that their reserves with the US are safe. And so therefore, they have no choice but to go out and to diversify into gold. The trouble is that they are so large, China is so large, that the last thing they want to do is go out and cause a monster bull ripping market in gold, because it won't allow them to buy enough of it.
Right.
So their goal is they are trying to accumulate gold for the long run. So when you start thinking about them, they're the one you're trading against, it becomes a little easier, because people will say, oh, like gold's ripping here, and they'll get all excited about it. Then all of a sudden something will happen and it'll be down $50 or $100. And then it'll get this point where people are finally getting bearish again, and they're like, oh, it's going to go down this time, blah, blah, blah. And then out of nowhere, just gets a bid again. And the reality is that is a pattern that we're going to see over and over and over again, because what it is China, when it gets too bullish, they're going to walk away. Like I saw Bank of America at one point was calling for $3,000 gold. Josh Brown, the CNBC contributor that usually hates gold, started talking about it. And, China's sitting there and they're like, okay, the Americans are like getting all bulled up about it. No sense in me adding to this, right? And I'll tell you a story about when I used to trade at a bank. I can't say which. I used to trade at Royal Bank and in the 90s. And I remember I was the index trader. Meaning the stock index trader. And so I did program trading. I bid on baskets. I did all sorts of things. And I had like 2 or 3 clients I'd talk to. And they were the big clients that had to allocate money. One point, I remember it was mid-90s, late 90s. I heard that one of the provinces was exclusively in bonds. Okay. It was an East Coast province, and their whole portfolio was in bonds. And they were in the process of changing it to own stocks. And everyone was going and pitching them, trying to convince them that to give them all their business and to use them as I can buy all the stock for you. And I said, I got to go talk to this guy. So I go and I speak to him, and I said, listen, I could sit here and I could tell you all sorts of great stories about like how I could provide the liquidity for you and how I'm going to be the greatest trader out there and stuff like that. But I said, it's going to all be bullshit, because the reality is you are so big you can't demand liquidity.
Mhm.
You have to provide the liquidity. And so what I did was I convinced this client that he shouldn't be buying on up days when everyone else is buying.
Mhm.
He should be buying on the down days, and he should be buying bigger and bigger as it goes lower and lower. He should be using the liquidity to his advantage instead of pushing it against himself.
Mhm.
And I think that's ultimately, you know, China might not do it on a day-to-day basis, but on the whole, it's the same thought process.
Mhm.
There's no reason for China to go, the People's Bank of China, to go when oil's like, you know, extended on an RSI, and Josh Brown is, you know, talking about how you should buy it, and it's making the cover of CNBC, and all of a sudden it's a great asset for them to chase it.
Mhm.
They just run the risk of turning it into a full-fledged, you know, rip roaring, like, you know, screaming bull market. And then the next thing they know, it'll be up $1,000, $2,000, and they won't have got enough. So my advice on gold is to think about it as if you were the People's Bank of China and you were trying to accumulate gold for the next 5, 10, 20 years. How would you do it? And I contend that the easiest way to do it is to just, whenever it gets too excited, step away, let it sag back down, and then buy it again when, you know, when people are getting bearish.
Mhm. Yeah, I think it's a really important point because, as you say, you know, this is another one of those markets that's just seemed to have changed. So, do you think that really, you know, when we have this, let's say, technical analysis that says, oh, we could go back down to 2,200 or something like that, do you think that dynamic has changed dramatically?
Yeah, I don't listen to any of that. I listen. Could be that we go back down to 2,200 because for whatever reason China walks away.
Mhm.
But to me, I don't see them walking away. And as long as the fundamentals continue to be the way I think they're going to be, and in fact, I might make the argument that Trump is going to make it more likely that China is going to accumulate more gold. There's no reason to start getting too bearish. Like, that's the way I look at it. Yeah. Could they walk away and let it go down 500? Sure. Maybe.
Mhm.
But I don't think that that's their playbook. So, and every time, if you kind of think about this bull move, how many gold bulls do you know, Tom, that didn't catch it? Because I know a lot, right? Like, between the dollar and the rates, lots of gold bulls weren't long it.
Mhm.
They kept saying, "Oh, it's going to come in. There's no reason for it to be up here." Like, they were like, they're forgetting now because now the action's a little better, but a lot of them missed it. And I think that this will be just another case where they'll get too cute. And my advice on gold is don't get too cute.
Mhm.
Remember who you're trading against. And as long as the fundamentals are there in terms of the PBOC buying it, then I'm not going to change.
Mhm.
And to your point, I don't think it trades anything like it used to do.
Mhm.
Like, it's completely different asset. It used to trade with the dollar, it used to trade with rates.
Mhm.
But I've been saying for a long time now, put all those relationships away. You know, I see like Gunlock talking about like the copper gold ratio. Forget it. It doesn't matter anymore. Like, that's like, gold has changed its use. It's changed who's playing in it. And until they're gone, then there's no point using those old playbooks.
Mhm.
And I still contend that by the end of it, you're going to be giving, like, the last bit, like, will be China chasing it at the end for whatever reason. And then that's the point when you're like, okay, like, I don't know if that's like 5,000. There will hit a point where I'll be like, okay, you know what? They're openly buying it now. They're panicking. This is crazy. This makes no sense.
Mhm.
But we're early in the China accumulation of gold.
Mhm. Yeah, like you say, compared to one tiny little province, you know, moving into and needing liquidity, you're dealing with an entire government that thinks very long term and
Yeah.
very strategically. So
It has the
there's
biggest reserves out there
Mhm.
of their country. Think about it. They have these reserves in a country that is openly hostile to them.
Mhm.
Like, what it would almost be like kind of wrong for them not to do it. Like, they're sitting there, like, you just from a fiduciary point of view, if I was on the People's Bank of China, I'd be like, we got to buy a lot of gold. Let's figure out how to do this. So let's just VWAP this any day that is down. Like that's what I would be doing. Any down day, I would be 10 or 20% of the volume. And that's what I would do. I just wouldn't chase it on up days. I wouldn't add anything on the up days. Every down day, I would just be sitting there buying it. Now, while we're on gold, since I think you are like, this is a gold channel, right? I am bullish on the miners, and I know everyone hates them. I get it. They think it's terrible. But you know, the thing about it is, I was looking at, I don't know if this is still the case. I'm just going to pull it up on the Bloomberg. Everyone was crapping all over the miners. And for a little while there, the miners were up more than the Mag 7 year to date. Mm-hmm. Now, I don't think that's the case anymore. Let me just, do you mind if I just have a quick look here?
Yep.
Because I think, let's just have a look at Mag 7. Or should we do Qs? Let's just do Qs. Because Mag 7 is going to be a little hard to beat. Maybe I'm wrong. Maybe it's the Mag 7. So if I go look here, and everyone's all negative on the miners, and if I go look year to date, Qs are up 23%. GDX is up 20.5%. Like it's like, I don't know why everyone's so negative. Like, I don't get it. Like this
because everybody is expecting, 10, 20, 30 baggers.
But it's an index. Like, like even gold, let's look. I think for the first time, it didn't. So gold is up 28%. So the miners are definitely underperforming, but they're not as bad as they used to be. Mm-hmm. And so here, I'll give you something that I'm doing that I really think is ripe. I think gold is going up so fast now that it's going to be tough for the miners not to make money. Like, I really do. I think even they will have trouble spending and buying enough jets and wasting enough money like to do it. So the trouble about the miners is it's a very small subsector, right? Like it's like the big guys, they trade Newmont and that's it. Like if you're sitting there and you're Fidelity, you're basically, it's tough for you to look at the little guys. Mm-hmm. But having said that, I really think that I talked a little bit earlier on the show about the pod shops and the quants. Mm-hmm. I think there's going to reach a point here where the EPS on these miners, it's going to start screening so well, they're going to start chasing them. Mm-hmm. And I think we're there. Like, I think that we're finally at the point, and I think we could get a situation where gold miners outperform gold next year and is actually one of the best subsectors out there.
Because of that contrast and that.
I think they're going to start making money. So the fundamentals will finally kind of flip positive. And then I think that the amount of money that is based upon those quantitative factors will push it up more quickly than people expect. Mm-hmm. And it's a small little group, and it doesn't take very much. Like we trade it and we think it's big, but like when you're like real big money, like, NVIDIA's, we should do it. I bet you the entire GDX market cap is probably less than NVIDIA. Mm-hmm. I don't know that for sure, but it wouldn't surprise me if that's the case.
Yeah.
Right. Like it's a tiny, tiny group. Mm-hmm. So I think that it's going to screen better. They're going to make more money. And then all of a sudden it's going to become a positive feedback loop, and you're going to get a little mini bubble. I call them the rolling mini bubbles. Mm-hmm. I think there's one due in gold miners. I don't know.
I think you and I talked about the rolling mini bubbles on our last conversation.
Okay. And I'm calling it now. I think that the gold miners are due for a rolling mini bubble.
Well, I know many of the listeners of this show are happy and really, really holding their breath for that exact situation. Kevin.
I know, but you know what? I'll bet you more people are skeptical and they'll be saying, no, there's not a chance. I've been hurt too much. And I'll leave. I love this line from Don Cox, who's a very famous Canadian money manager or strategist. He says, those who know it best love it least because they've been burned the worst. Mm-hmm. And I feel like that's a lot of people that are become so bearish on the miners because it hasn't worked for them for nearly long enough. But I think that they're already trading much better than people give them credit for. And I suspect that 2025 is their year.
Mm-hmm. Well, certainly sentiment is got to be at an all-time low as well. So
especially for that up 20%. Mm-hmm. Like literally it's 20%. And yet everyone's like, oh no, they suck. Mm-hmm. I'm like, what? Like, it's like, they're not that bad. Like, it's like, what do you like? I don't know what you guys want. Like, Anyways, but I think that like it wouldn't surprise me if they had an up 50% year.
Mm-hmm.
Like that's the kind of that's my hope, my pipe dream.
Yeah. Well, again, you and everybody else in this sector.
As they like to say, from your lips to God's ears.
Yeah. Okay. Well, we'll hold our breath till it happens, Kevin. All right, Kevin. Well, I really appreciate you really taking the time to dive so deep into all these subjects today. I always enjoy speaking with you because you do such a good job of explaining things, in a really understandable way.
Oh, thank you very much.
And you also write an excellent Substack. It's called the Macro Tourist.
Yeah, and if anyone wants a sample, just email me, Kevin at the. Okay, let me try this again. Kevin at themacrotourist.com, and I'm happy to fire you off some stuff.
Excellent. And of course, on Twitter at Kevin Muir, MUIR.
You know what? I'm not very good on Twitter. Don't go there because I'm kind of checked out. So don't. If you're interested, you can go to my Substack, and the chat is free. So welcome to jump in on the chat. Like you just go to my Substack and there's a chat button. Go there and that's free. And
it's actually quite active.
Yeah,
I was checking through it, and there's lots of good conversation there on.
Yeah, lots of great people in there, and it's some funny things. And as I tell people, they say, "What are the rules?" And I said, "There's only one rule: is to be kind." And that's it. Otherwise, you're welcome to talk about whatever you want, as long market related. And it's a lot of fun, and people have a great time, and there's a great community there.
Mm-hmm. Absolutely. Kevin, thanks so much for your time today. Always
my pleasure. It's always great being on your show. Thanks for your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.